This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and start to pull things together at the end, just some dotting the I's, crossing the T's. I think there's two bits that we need to look at. In this first video, we're going to look at the hedge accounting criteria and hedge effectiveness, and then we'll go through there and finish it off in the next one by going through there and looking at the world of hedging disclosures. Okay, you could get a question on each of them. Isn't going to be too technical, isn't going to be too tricky. I don't think you need to learn the criteria for hedge accounting and have a basic understanding of how hedge effectiveness works. We've spoken a bit about hedge effectiveness already, but in speaking about it, we've said we'll leave it till now, so that's when we'll cover it in detail. So the key bit is as you go through and look at all the different types of hedge, fair value, cash flow, net investment in a foreign operation, that there's plenty of scope for manipulation, isn't there? Because if you look at the net investment hedge, you have that situation whereby you've got the net asset to the sub, goes with any gains and losses to OCI. The loan that you have goes to OCI as well, doesn't it? The gains and losses there. And the scope, isn't there, to manipulate various bits and pieces with regards to hedging by saying, well, look, let's pretend that I'm not hedging. If you can anticipate that there's going to be gains on the net assets, or so let's just say losses on the net assets, you might just want to go through there and just leave those losses in OCI, because let's face it, nobody bothers looking at OCI. What is it? Okay, knowing that you've taken out the loan to hedge it, so that when you've got the gains and losses, or I should say the loss on the net assets in OCI, under hedge rules, that the gain should go there, shouldn't it, and offset the loss. But you might then see, well, hang on a minute, I've got this nice gain on this loan. Okay, let's pretend that I'm not hedging. Okay, because then you've got a nice gain going through profit or loss. Okay, shareholders take note when things go through profit or loss, don't they? Okay, so there's plenty of scope for manipulation, isn't there? Likewise, on your cash flow hedge, you've taken out this instrument to protect the future gains or losses on the item. The gains and losses on the instrument go through OCI because you've hedged, but maybe you've got a gain on the instrument. So it's like, well, let's pretend that I'm not hedging and just throw it through profit or loss as it is a derivative financial instrument. Okay, and all of a sudden you've got some nice gains going through profit or loss, which makes your earnings looks good and your distributable profits look even better, and you can pay higher dividends. So there are issues there. So what we have to have are rules. Okay, so what you have to go through and do is you have to document each hedge. Okay, you have to have specific documentation in place that goes through there and identifies what the item is. So is it the overseas net assets in a net investment in overseas net assets hedge? Is it a highly probable future transaction? Okay, with regards to your cash flow hedge, or is it maybe some inventory or an investment that you've made with regards to the looking at your fair value hedge? Okay, so you have to specifically detail what the item is. Okay, you can't just chop and change. Okay, because you need to have a particular item that is hedged by a particular instrument. So within the documentation, you have to choose the instrument and the item and match them up. You can't just have an item and then have various instruments that you've entered into for speculative purposes and then just chop and change every year as to which instrument it is that you're going to use to hedge against the gains and losses on the item, because it's working in your favor that little bit better with instrument A as opposed to instrument B. Okay, so you need documentation of the instrument, you need documentation of the item. You also need to go through there and explain as well what the nature of the risk is that is being hedged, because without going too far into it, we've just hedged against very simple risks in terms of currency, in terms of price risk, haven't we? But within there as well, there could be additional risks that you're faced with. So if you go through there and think about an airline hedging against the potential purchase of fuel in the future, there is no specific financial instrument that we go through there and have with regards to fluctuations in the price of jet fuel. But what we can do is we can have the the item being the future purchase of jet fuel, and maybe the instrument being some form of derivative on crude oil, because the prices will be very closely linked. So there's a price risk in there, but again, the issue that you've got there is that the purchase of the jet fuel might be in a different currency to the dollar instruments with regards to the financial instruments on crude oil. So therefore you've got some extra risks in there. You've not just got the price risk, but you've also got the currency risk as well. We've just kept it very simple, nice simple back-to-back hedging effectively, okay? But if it gets more complex, and trust me, it does get very, very complex, you need to specifically say what risk that instrument is protecting within that item, okay? Likewise as well, we're getting the effectiveness, hooray! We need to look at how effective the hedge is, okay? It needs to be within this range of 80 to 125%, okay? So what you've got there in terms of measuring the effectiveness, you look at the change in value of the instrument divided by the change in value of the item, okay? So the gain divided by the loss divided by the gain. It doesn't actually matter which way round you do it, hence it's the 80 to 125, okay? Trust me that if you are within 80 to 100%, you will also be within 100 to 125% if you were to invert the formula, okay? But what that then says is that if you're 79% effective, then the rules of hedge accounting then don't apply, and you go back to the normal rules, okay? Which is just a little bit crazy, which is why in future iterations of the standard, the new standard that's in place now, that's actually dropped out, okay? The hedge effectiveness rule has dropped out, okay? But for your exams, it needs to be in between 80 and 125%, okay? And then there's another situation as well, in a cash flow hedge. So just note, it's a cash flow hedge, not fair value, not net investment in a foreign operation. That future transaction must be highly probable. So significantly more likely than not, it will occur, okay? There we go. Why? Because otherwise what you might do is you might have an instrument that you've entered into. The instrument is making losses, and you think, oh, right, what I'll do is I'll pretend that it's going to hedge, because that instrument, the losses normally go through profit or loss as a derivative. If I pretend that I'm hedging and say, look, there's a transaction that I'm going to hedge against in the future, so therefore I'll take the losses into OCI. Nonsense, okay? At some point in the future, like, oh yeah, those purchases I said I was going to make didn't materialize, okay? But not to worry, all the gains and losses on the actual instrument themselves have leveled out over a period of time, so you get the idea, okay? For a cash flow hedge, it has to be highly probable, okay? So let's just go through there and put in little bits and pieces, so some extra notes, some illustrations as well, before we start looking at the illustration and the example that you've got within your notes. Just a bit more on this hedge effectiveness criteria. Remember, it needs to be, is it between 80 and 125%? And there are two scenarios that we need to look at, okay? An over and an under hedge. Because if we have an over hedge, that's whereby we have ineffectiveness. Technically, under or over, there is ineffectiveness, but per the rules, it's only if there is an over hedge that there is ineffectiveness. Because if there is ineffectiveness, then the gain or loss actually goes through profit or loss, okay? So what you've got there is if the change in instrument is greater than the change in item, okay? So the gains and losses that we're making on the derivative are more than the change in item. It means that those gains and losses on the instrument are doing more than what they need to do, okay? So we've got a little bit extra of a gain, a little bit extra of a loss. So therefore that ineffective element will go there to profit or loss, okay? Then what you've got there is if you have an under hedge, so here your change in the instrument is a bit lower than the change in the item, so therefore it's still effective, but the gains and losses on the instrument aren't doing enough, so to speak. So it's quite happy there to take those gains and losses into OCI fully, and there's no, if you like, ineffectiveness. Okay, so let's just go through there, because that's quite complicated, I think. Let's just go through there and have a play around with an example. Okay, an illustration, whichever you want. So let's just say you've got an instrument. That's usually your derivative, isn't it? Okay, and you've got a 0.5 million gain upon it, and on the item you have a 0.4 million loss. Okay, so for the item, all the gains and losses go to OCI. Okay, but in terms of the instrument, the issue that you have there is that this 0.5 million is greater than at the reporting date. Okay, the 0.4 million loss, isn't it? Okay, so the change in the instrument is greater than the change in the item. There's the loss of 0.4 million on the item. Ideally, the gain would like to be 0.4 as well, but it's just a little bit more. Okay, so really we should only take the gain up to the level of the loss. Okay, and then anything extra that we've made as a gain goes to profit or loss. Okay, so as it says there, we are over hedged. The change in the instrument is greater than the change in the item. The ineffectiveness is basically the difference between the 0.5 and, is it there, the 0.4. Okay, so 0.1 goes through profit or loss, and 0.5 of the gain, sorry, 0.4 of the gain goes to OCI. Okay, just then be careful. What have we got here? We now have an under hedge scenario whereby the gain on the instrument, so remember the derivative, is less than the loss on the item. So the $1 million loss on the item all goes to OCI, and because we are under hedged, all of the gain as well on the instrument also goes to OCI. So here's my loss on the item, here's my gain on the instrument. Okay, the gain on the instrument isn't doing enough, is it? It needs to be up here a bit, but all of this loss here has gone to OCI in the item, so the gain here is allowed to offset it in full, and it all goes to OCI. So what you have is that there is no ineffective portion on the instrument. Okay, if I just go back, can I find it? I think I can here. If we go back to, is it what we saw in the previous video? Okay, when we looked at our net investment hedge, you can see here now that what you have is that the gain on the instrument, or sorry, the loss as it was here on the instruments, is less than the gain on the item. So that is an under hedge, isn't it? There is no ineffective elements. Okay, if the loss over on the far side ended up greater than the 65360, then that means that the instrument is performing better than what it should. We would only take the loss up to 65630, and any excess loss would go there through profit or loss. Okay, excellent. So what you've got there, there's a little example, example number 5, all about, is it the hedge effectiveness. Okay, and it sort of combines the overseas net investment hedge example from earlier, and then asks you to work out the hedge effectiveness. You know, if we go back, we didn't work it out, did we? But we'll show that it is effective. You know, what is the effectiveness as a percentage? You've got 5,823 over 65360. So 5,823 divided by 65360 is the 89.999. So that's 90%. So that falls within the limits, doesn't it? Okay, you've got the change in the instrument divided by the change in the item. If we go back to here, again, you've got there to work out your effectiveness. 0.5 over, is it 0.4? That gives me there, is it 125%? So that's on the limits, but it's still effective. And then here, 0.8 divided by 1. Oh, I'm not even going to tap that on my calculator. That's 80% effective. Okay, so it's still within the limits. Okay, excellent. So on that example, example number 5, I think you can go through there and have a play around with it yourself. Okay, work it through, see how you get on. All it wants you to do is it wants you to calculate the effectiveness of the hedge at the year end. So what we need to go through and do there is we need to look at, is it the change in the value of the instrument divided by the change in value of the item. Okay, have a go, see how you get on, and then we'll talk through it in a moment. Okay, so how did you get on? Did you get about 90%? I think that's what it works out as. Okay, let's just go through there, double check, make sure that you're happy with it. Okay, so what you've got there is we need to look, is it at the instrument, and is it there, careful, the item. Okay, so the instrument that you have there is a 45 million euro loan. So what you've got there is initially, oh careful, in euros, initially 45 million, was it there at 1.1. So 45 divided by 1.1 gives me there $40.91, and then at the end of the year, at the reporting date, it had moved to 1.15. Does that give me there, is it 39.13 million? You don't actually need to think about whether it's a gain or a loss. You can if you want. You've got a reduction in the value of the loan. A reduction in the value of a loan is a good thing, so that there is a loss, isn't it? Okay, sorry, a gain. Careful. Yeah, reduction in the value of a loan is a gain. Because all you need to do is just do the difference in the numbers. Who cares whether it's a gain or a loss? The question wasn't asking that. The change is there as $1.78 million. Okay. If we go through there and look at the item, if that memory serves me right, my memory's fading. It's getting worse as I get older. But there we go. 50 million euros. So what you've got there is, again, you do your 50 million divided by the 1.1. Is that the $45.45 million. If you then go through there and take the 50 million divided by 1.15, does that give me, is it 43.48? Again, you don't need to think about whether it's a gain or a loss, but what you've got there is a loss, isn't there? Because the value of the assets have fallen, which offsets the gain that we have on the loan, whereby the value of a loan, a liability, fell. It's good when the value of liabilities fall, and therefore we have a gain. Okay, the change, what have we got? 45.45 less 43.48 is there, is it as 1.97 million. To work out the effectiveness, it's the change in the instrument divided by the change in the item. That works out there, is it, if we want to be specific, 90.4%. There we go. Okay, excellent. Again, if you want to be specific, you didn't have to within this question, but we're just adding a bit as we go along. A reduction in a liability is a gain. A reduction in your assets is a loss. Is that under or over hedged? Under hedged, isn't it? Okay, because here what you've got there is that the change in the value of the instrument is less than the change in the value of the item. So therefore, that is an under hedge. So what will go through and happen is that all of the gain on the instrument will go to OCI, trying to claw back as much of that loss and offset it as much as possible of the loss that you have there on the item, being the overseas net assets that's gone through OCI anyway. Okay, there you have it. Pretty tricky, isn't it? Okay, practice some of the questions, but I think what you'll find is that as tricky as it is, things aren't going to change much in terms of the exam style questions and what you could expect. I don't think there's going to be anything thrown in there that would be unduly tricky. Okay, I think the examiner will want to make sure there that you can calculate effectiveness and know whether it is under or over hedged. Okay, other than that, we'll finish things off in the next video when we briefly look at the world of financial instruments and disclosures. See you in a minute.